These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. The volatility index refused to raise her voice this week. Headlines screamed about failed breakouts and protective put buying and a darkening technical cloud hanging over the S&P 500. Yet she stayed anchored right there in the high teens with this quiet, contemplative stubbornness that felt almost defiant. And that single refusal to confirm the fear narrative became the entire story of the week. You and I both know what usually happens when the pundits all line up on one side of the boat. This time the boat never tipped. Smart money noticed. Disciplined premium sellers who trusted process over panic collected their theta day after day inside clean, defined risk structures, while the volatility index simply would not scream. She refused to whisper warnings either. She refused to validate the insurance-buying surge that barons told everyone about. She refused to reward the reactive traders who kept staring at those failed breakouts, looking for the next leg down. Instead, she sat in what I can only describe as a contemplative zone between 18.5 and 20.5, and let the math do the talking. And the math this week was very clear. When implied volatility stays stubbornly elevated against realized volatility that barely crossed 14% on a 10-day basis, the edge belongs to those patient enough to sell the volatility risk premium inside strict boundaries. That is not opinion. That is what the tape actually showed from Monday all the way through Friday close. And now you and I are going to walk through exactly how that story unfolded, because this was one of those weeks where the headlines and the price action told two completely different tales, and the volatility index was the only character who refused to switch scripts. Let's start at the beginning. This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. Monday morning, the market walked into a world that had already priced in a certain amount of policy stability. The Federal Reserve was widely expected to hold interest rates steady at its two-day meeting that would conclude later in the week, and that expectation had been baked into positioning for days. Yet the Supreme Court had just issued a ruling on tariffs that immediately opened the door for fresh levies and fresh uncertainty across global trade. You remember the headlines. Trump announcing 25% tariffs on any country still trading with Iran. The resumption of trade war language with China. India and the United States still struggling to find common ground on a bilateral deal. CNBC told you it was escalation. The Atlantic Council told you Beijing was watching both Trump and the Supreme Court with one eye each. The New York Times framed it as new uncertainty in global trade. But here's what the tape actually showed on Monday. The S&P 500 opened near recent highs and simply refused to break lower in any meaningful way. The volatility index opened the week right around 18.5, and she barely budged. She did not scream at the tariff headlines. She did not whisper about potential supply chain disruptions. She simply held her ground in that high teens contemplative zone as if she already knew the market had front-run most of the uncertainty weeks earlier. You and I know what really happened here. The tariff rhetoric had been leaking out for days. Smart positioning had already adjusted, and the volatility index was not about to reward latecomers to the fear trade. At the same time, crude oil jumped from $89.61 to $92.13 on Monday. That move had everything to do with the sudden flare-up in Middle East tensions. The headlines told us Iran had been attacked. Oil prices were jumping because of it. Moscow was calculating benefits from the Gulf conflict. The Ukraine war and Middle East tensions were merging into what some analysts called a single geopolitical crisis. Russia was emerging as an early winner of the Iran conflict, according to Time magazine. Yet even with crude firming, the volatility index refused to confirm any broader risk-off panic. She stayed anchored. That disconnect was the first unexpected connection of the week. Oil was listening to the geopolitical drums. The volatility index was not. And that told you everything about how contained the real risk actually was. Gold opened the week at $4,806.60 and immediately began drifting lower. The dollar was firming. The DXY climbed from 98.05 to 98.41 on Monday. Higher real rates expectations ahead of the Fed meeting were weighing on the precious metal, and yet equity markets ground higher anyway. That was the second quiet signal. Gold was pricing in dollar strength and Fed steadiness. The S&P 500 was pricing in continued mechanical upside without broad animal spirits. The volatility index sat in the middle of those two stories, refusing to pick a side. She was in one of her moods again, the contemplative one, the one that says, I see your headlines, but I'm not going to react until the math forces me to. Bitcoin opened near $75,873. Ethereum sat at $2,315. Crypto was not leading. It was not lagging dramatically either. It was simply along for the ride in a week that felt increasingly mechanical. No wild risk-on surge, no flight to safety, just steady contained action that favored those of us who had already placed our conservative iron condors with 3 delta put wings and 5 delta call wings exactly where the rapid skew AI model told us to put them. Tuesday followed the same script, but with a twist that tested everyone's patience. The VIX edged a little higher intraday, touching 20.48 at its peak. That was the highest we would see all week, yet even at that level she never really raised her voice. The S&P 500 continued its grind toward fresh all-time highs. Failed breakouts were being discussed everywhere. MarketWatch warned of a darkening technical cloud. Schaefer's talked about pullback risks as the index approached key trend lines. Barron's noted the surge in protective put buying. The fear trade was being sold aggressively by the pundits, but the volatility index would not confirm it. She would not scream. She would not even whisper a clear warning. She simply moved into what I can only call her stubborn refusal phase. That is when you knew the edge was shifting hard toward disciplined premium sellers who were willing to sit on their hands. Our model issued a decisive hold signal during the peak 0D TE gamma window on Tuesday between 1:30 and 2 o'clock Eastern. Let me tell you what really happened in that window. The tape showed a brief gamma spike that looked scary on the surface. If you had been watching only the headlines, you might have been tempted to adjust. But the model said, hold, do not touch it, let theta work. And that single decision to respect the hold separated the process traders from the reactive ones. Meanwhile, the Federal Reserve was in the middle of its 2-day meeting. Headlines said they would hold rates steady and signal one cut amid inflation uncertainty. Warsh was out there talking about a new approach to measuring inflation. CNBC explained how steady rates would impact consumer costs. CBS News walked through what to expect from the first rate decision of 2026. The bond market barely moved. The 10-year yield went from 4.25% to 4.29% and then held right there. No panic, no euphoria, just the quiet acceptance of policy stability. And that stability is exactly what kept realized volatility suppressed between 10.4% and 14.2% on a 10-day basis. When policy is predictable and geopolitical shocks are already priced, the volatility risk premium becomes harvestable. but only for those with the discipline to stay inside defined risk. That Tuesday hold signal proved to be the pivot point of the entire week, because once we respected it, the path forward became much clearer. The market was not going to give us a clean, directional break. It was going to give us range-bound chop inside the expected daily range, and the volatility index was going to stay right there in the high teens, refusing to validate either the bulls or the bears. That is when the real story of the week began to reveal itself. Wednesday is when the twist truly arrived, not in the form of some dramatic breakout or crash, but in the form of something far more interesting, the complete absence of the panic that so many had been forecasting. The S&P 500 pushed toward fresh all-time highs, closing the week ultimately near 7,165. The exact path there was choppy, contained, and mechanical, yet the pundits kept focusing on the failed breakouts and the technical cloud. What they missed was that the volatility index had gone into full, quiet defiance mode. She settled back down near 18.55 and simply would not raise her voice, no matter how many insurance buyers flooded the put market. This is where the third unexpected connection of the week revealed itself. While equity markets ground higher and the volatility index stayed calm, crude oil continued to firm, moving from $92.96 to $95.85 by Thursday. The Iran attack headlines had pushed oil higher earlier. OPEC felt vindicated by its no-peak demand forecast. Nigeria was preparing to export a new crude grade. Venezuela's production remained crippled, down 75% since 1998. Yet despite all that energy market noise, the broader equity indices refused to sell off in any sympathetic way. The bond market stayed range-bound. The dollar kept its modest firmness, climbing as high as 98.80 before settling back. And that is when you realized the invisible thread. Geopolitical tension in the Middle East was moving oil. Policy steadiness from the Fed was keeping volatility suppressed. Dollar strength was weighing on gold, which had fallen from $4,806.60 down toward 4,700 territory before a modest recovery. Crypto was grinding modestly higher, with Bitcoin reaching $78,203 midweek, before pulling back slightly. Each asset was telling its own story. But the volatility index was the narrator who refused to let any single story dominate. She kept the entire market inside a contained range. And that containment is exactly what allowed our conservative iron condors to capture clean theta day after day. Wednesday also brought one of the more fascinating micro-moments of the week. At 1:47 p.m. Eastern, the 0DTE 7100 puts saw a rapid gamma spike. The offer went from $1.30 all the way to $6 in a matter of minutes. On the surface, it looked like the sky was falling. Headlines about pullback risks and technical clouds would have had you believing we were on the verge of something serious. But the model had already flagged the gamma exhaustion setup. The spike happened inside the expected daily range. It exhausted without breaking structure, and our adaptive layered VIX hedge remained on standby, never needing to trigger, because the volatility index simply would not confirm the move. She stayed in her contemplative mood. She refused to scream, and that refusal protected every disciplined seller who refused to adjust their position during that 1:30 to 2 o'clock peak gamma window. You and I both know how tempting it is to touch the position when the screen starts flashing red. But this week the tape showed that those who sat on their hands were rewarded. The iron condor with the 7,015 put and 7,315 call that we placed earlier in the week collected its 65-cent credit and simply let time decay do the rest. That is the power of respecting the rapid skew AI signals. 4 clear place days, and one very important hold. The hold on Tuesday proved to be the highest expectancy decision of the entire week. Thursday brought the Federal Reserve's actual decision. They held rates steady just as expected. They signaled one rate cut amid inflation uncertainty. The mainstream financial media framed it as cautious. The tape framed it as confirmation of the stability we had been trading all week. The 10-year yield ticked up slightly to 4.32% before settling back. The dollar reached its firmest level of the week at 98.80. Gold traded down to $4,705.10. Crude touched $95.85 before giving back a little ground. Bitcoin and Ethereum traded in a narrow range, showing that institutional risk appetite remained measured rather than euphoric. And through all of it, the volatility index refused to break out of the high teens. She would not validate the fear. She would not punish the complacency. She simply held her ground like a seasoned trader who has seen these narratives come and go many times before. That stubbornness created the perfect environment for defined risk premium selling. Our conservative 3 delta, put wings, and 5 delta call wings stayed comfortably outside the price action. The term structure remained in healthy contango with roughly 4.71 points of spread and nearly 14% term premium. Implied volatility continued to overprice the realized moves by roughly 6 points on average. That is not a small edge. That is a structural edge that disciplined traders have been harvesting for years when the conditions line up exactly like they did this week. By Friday, the tension had largely resolved in the most boring way possible. The S&P 500 settled near its recent highs after a week of contained chop. The volatility index closed right back where she spent most of her time, around 18.55. Gold recovered slightly to $4,722.30. The dollar settled at 98.51. Crude closed at $94.40 after flirting with higher levels midweek. Bitcoin and Ethereum showed modest net gains for the week, but nothing that suggested a breakout in risk appetite. The entire market seemed to exhale. The tariff headlines had not produced the breakdown many feared. The Fed had not surprised anyone. The geopolitical tensions in Ukraine and the Middle East had moved energy prices, but had not spilled over into broad equity volatility. And that is when the real lesson of the week crystallized. In an environment where fear is being aggressively sold by the financial media, but not confirmed by the volatility index, the highest probability path is almost always the boring one. Sell defined risk premium. Respect the model. Let theta work without interference. Never adjust inside the peak gamma window. Those of us who followed that discipline saw our iron condors expire safely inside their expected daily ranges 4 out of 5 days, with one strategic hold, preventing unnecessary interference on Tuesday. The win rate was not perfect. It never is, but the process was, and that is what separates survivors from casualties over time. Now let's pull back and look at the bigger picture, because this week offered several invisible threads that the mainstream coverage completely missed. First, there was the divergence between oil and equities. Crude climbed steadily from $89.61 all the way to $95.85 before settling back. That move was driven by genuine geopolitical supply concerns out of the Middle East and OPEC's continued confidence in demand. Yet the S&P 500 refused to roll over. It ground higher to fresh all-time highs. That decoupling told you the equity market was treating the energy spike as isolated rather than systemic. The volatility index agreed. She never translated that oil strength into broader fear. That single disconnect was worth paying attention to because it showed how policy stability from the Fed was acting as an anchor against geopolitical noise. The second invisible thread involved the dollar and gold. The The DXY climbed from 98.05 to as high as 98.80 before closing the week at 98.51. Modest firmness, but enough to weigh on gold, which fell from $4,806.60 down to $4,698.40 before a partial recovery. What the headlines called trade war escalation and tariff uncertainty, the bond market and the currency market treated as already priced. Higher real rates expectations kept the dollar supported. Gold responded exactly as you would expect in that environment. Yet equities continued their mechanical grind higher. The volatility index sat in the middle of that triangle, refusing to break higher, even as protective puts were being aggressively bought. That refusal was the tell. The market was not buying the fear narrative, no matter how loudly it was being sold. The third unexpected connection came from crypto. Bitcoin moved from $75,873 up to $78,203 midweek before settling at $77,455. Ethereum followed a similar path, ending the week near 2,316. Not a leadership move, not a collapse either, just steady, contained behavior that mirrored the equity market's own mechanical action. What that told me is that institutional flows were not rushing into risk assets with both hands. They were allocating with caution. The lack of crypto outperformance relative to the S&P 500 suggested that animal spirits were not fully in control. The volatility index noticed. She refused to price in the kind of breakout volatility that would accompany genuine, broad risk-on sentiment. Instead, she stayed in her high teens contemplative zone and let the premium sellers do their work. We also saw the euro weaken against the dollar, moving from 1.178 down to 1.168 before a small recovery. That forex move aligned with the dollar firmness and further weighed on gold. Meanwhile, the 10-year yield ticked modestly higher from 4.25% to 4.32% before settling at 4.31%. Nothing dramatic, just the quiet acceptance of steady policy. When you put all these cross-asset movements together, the picture becomes clear. The week was defined by contained mechanical action inside a policy-stable environment where geopolitical noise moved certain assets but not the broader volatility regime. The volatility index was the character who saw all of it and chose to remain quiet. That quietness created opportunity for those structured correctly. This brings us to the scorecard for the week and what it reveals about both the process and the path ahead. Our rapid skew AI model issued 4 clear place signals and 1 decisive hold. That 5-day pattern was not random. The hold came exactly when 0 DTE gamma exhaustion was most likely to trick traders into reactive adjustments. The fact that we respected it preserved capital and positioning for the 4 clean place days that followed. Each of those place days used the conservative wing structure with 3 delta puts and 5 delta calls, sized appropriately inside expected daily range parameters. Average credit collected was around 65 cents per contract. The structures stayed inside their defined risk boundaries the entire time. No ALVH trigger was needed because the volatility index never breached the thresholds that would have activated the layered VIX call hedge. That is the beauty of the framework when it is respected. The math does not care about the Supreme Court tariff ruling. It does not care about Trump's 25% levies on countries trading with Iran. It does not care about the merged geopolitical crisis between Ukraine and the Middle East. It does not care about the Fed's steady hand or the modest dollar firmness or the surge in protective put buying. The math only cares about where implied volatility sits relative to realized volatility, where the term structure is priced, and whether the price action remains inside the probabilistic range. This week, the math favored sellers of the volatility risk premium inside defined risk structures. Those who trusted that math over the headlines were rewarded with clean theta capture and minimal interference. Those who chased the narrative or fought the hold signal likely gave back premium unnecessarily. And honestly, this was one of those weeks that reminds me why patience remains the only lasting edge in this business. The pundits sold fear. The volatility index refused to buy it. The result was a contained, range-bound week that looked boring on the surface, but delivered consistent opportunity to those structured for exactly that outcome. The iron condors did what they were designed to do. They harvested the overpricing of implied volatility relative to the subdued realized moves. They respected the gamma exhaustion pins. They let time decay work without emotional interference. That is not luck. That is process. And process is what survives across all market regimes, whether the headlines are screaming about tariffs, or AI executive orders, or clean water policy, or Europe's changing approach to big tech regulation. The defined risk math does not read newspapers. It reads probabilities. And this week, the probabilities favored discipline. Tomorrow in our Sunday forecast, I will walk you through exactly what I am watching Monday morning. The economic calendar, the volatility term, structure setup, the positioning of our existing Iron Condor campaigns, and the key levels that could shift the rapid skew AI signals from place to hold or back again. You will not want to miss it, because the framework that served us so well this week is the same framework we will use to navigate whatever comes next, whether it is fresh tariff developments, fresh Fed commentary, or fresh geopolitical shifts out of the Middle East or Eastern Europe. The protection does not come from predicting those events. It comes from structuring positions that do not care about the headlines, only the math. If you found this summary valuable, consider upgrading to Pro or higher for the full twice-daily VIXShield market summaries, proprietary signals, and private RSS feed. Visit VIXShield.com to learn more. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. And now you know what the tape was really saying this week.